Welcome to STEM Entrepreneurship, the deep tech approach. Well, we're into the last episodes of STEM Entrepreneurship, from evaluating entrepreneurial opportunities to designing the business, crafting the strategies, and then finally financing the entrepreneurial ventures. The smart perspective. And a lot of people say, oh, really what is smart? It's all about money, right? Yeah, it's about money, but it's a lot more than that. It's about smart money. All right, financing entrepreneurial ventures is about smart money. But how can money be smart or smarter money? Let's look at the smart perspective. But really, if you want to be smart, do you just take money from any places, from anybody, at any time? All right? It may come back and haunt you because you may get a group of investors that want to cash out within 2 years and they are not ready. Or you won't get a group of investors who want you to run the business the way that they presume, or they want it to be, maybe because of their personal perspective, because of their last experience. So it's really, really different from where maybe the way you want, the vision and the mission of the company. So it's important then to be smart about this. So the question is when you want the money. Of course you need for your development, especially for technology ventures. Not just when, but how much. Do you take everything? I say, I need $1 million, or I ask for $1 million, or we start with 100. Do you have milestones? And then from who? Anybody in the streets. From the venture capital. Or sometimes we call, in this festive season, the angels. Well, let's take a look at the financing life cycle for high-tech or high-potential venture. Well, the simplest way to illustrate is that when you have an idea and you need to spend time to conceptualize the idea, develop the technology, comes up with a prototype, test it, and these are all need money, right? So it's sinking down until it starts selling. When you start selling, then you move up your curve, and then eventually you're profitable. Now, therefore, from a venture perspective or a startup perspective, we are really concerned with cash. How much cash in your kitty at any one point in time? So if you look at this, the cash goes down and all the way it comes up. This is going to be a long time, right? So there's a lot of risk involved. And if you look at there, some people call it the venture or the valley of death, right? Before it becomes positive. Become positive, the gradients will go increase, right? That's where you start selling the product. And therefore, when you look at the various phases of a technology venture, is thinking, coming up with the concepts, bootstrapping, using your own money, the 3F, the crowdfunding, the accelerators, the angels, and of course the venture capitals. So that's one way of looking at it at the early stage. But when you move away from the early stage of the valley of death, then you move on to actual serious financing. Serious means a lot more money. And you can see that at the break-even point, at the traction point, there are lots of other people who want to invest in you, and that could become mainly venture capitals. And venture capitals could be just purely fund manager, or they could even be corporate venture capitals, strategic alliances, companies that want to work with you, companies that want to license from you, and you have then potentially have exit. What is exit? It means sell your company away by mergers and acquisition, lesser mergers, more acquisitions by bigger companies, and of course the holy grail for people who are in the entrepreneurial setting is the IPO. And therefore, what I have shown you is really the details of the value of death. There are accelerators, there are incubators, lots of people playing in this area, and of course the government also play in this area, and the government will help also sometimes in the ventures of serious funding, and we can book it this way: early stage, the series 1, 2, 3, or A, B, C, and then the late venture where you're in mezzanine, you're ready for acquisitions or IPO. All right, so this is the startup financing cycle. Well, if you look at it from another perspective, is how do I map concept to the typical money you raise versus the typical valuation? Well, that's a research mean, but is this just a guide? In different countries, it's different. But from pre-seed to seed, where you have the MVP, you build your products, right? The prototype, and the Series A, where it's growth, right? So early stage is between selling and before selling. Early stage is all about testing. Growth stage or later stage is all about selling and growing your companies. So if you look at the source of financing in the different stages, obviously the venture capital, and they will syndicate, and syndication means one guy will lead, the other guys will join along. You have the angel investors and the banks, which come much later. You have the corporate VCs, sometimes earlier, but generally much later. Strategic alliances, obviously much later. Now, so funding a venture, the first thing in Singapore especially, and in certain countries, many countries, the government play a very big part, but they recognize that the technology ventures are really engine of growth for the economies, and they love to create unicorns, $1 billion valuation startups. So grants becomes a very typical important thing for deep tech venture. While we are operating in universities or research institutes, you usually get a lot of grants. And in Singapore, we have quite a bit of grants, and under the Enterprise Singapore, we have this umbrella funding grant scheme called the Startup SG. Now, you can see that actually there are many schemes, but I want to focus on things that are very focused or important for founders of tech venture. Well, one way to look at it is actually, really is the first time you are the founders of a company. So it's a startup capital grant of 50,000, and they're required to raise and commit 10,000. So if you raise 10,000, you get 50,000. But there's a provision, right? Is that this is your first time, and they have a couple of guys coming together to start a company. So this is grants. Grants means no equity, no share in the company, and I think that's probably the better way for founders. Then there is something called the SG Tech Grant. So the grant will carry an equity component. So it's not just grant for you, but a certain percentage is actually can be converted to shares, so the rights to exercise a share subscription. All right, so if you look at the kind of grants that this tech grant of SG startup, you can see there are two options: proof of concept and proof of value. What is proof of concept? Means you're building the prototype to see whether it works, your technology works, right? What is proof of value? It means that you actually have find a customers. You have done this proof of concept and you want to validate the commercial merit of the concept, of that prototype, which means you must have a pilot project with the customers. And then what happened is that the proof of concept, according to these statements here, has up to $250,000 grant, and proof of value has up to $500,000 grant, $500,000. Now, obviously, in these two concepts or two grants, you would require an increase, not just existing, but increase in paid up capital of 10% and 20% of the grant. So 10% here, so if you are asking for 250, 10%, 25K. If you're asking for 500K in POV, it's not 10%, it's 20%. So 10% of a 500K is 50K, so 20% is 100K. All right, so is to have financial discipline. And also there's a conversion component of equity. So it's not purely grant, but it's something that can help you up. And the valuation is also not based on what is injected, but based on what's in the next round. So in line with all grants and all supports from the government, generally what is important here is that it must have at least 30% of a local shareholding. Okay? And of course, less than 5 years at the time of the grant application, and it must not be not more than 100 million or with staff less than 200. This is the Singapore definition of SME. It means SME can apply for this option. How about funding a venture at pre-seed? Okay, you have a great idea. You're trying it out in the lab, but then you need money. You may use a credit card, but it's still running out, you need more cash. So what we bring in the 3 musketeers, or not the 3 M's, there's a 3F. So what are the 3 F's? The 3 F's, and people normally say family, friends. That's easy, right? You go to the father and mother and say family, and ask a friend, hey, can I support you? Okay, great. So friends, and then there are fools, people who believe in you. And I think that is not a very good terminology, which I do not use. I always say that we should not use fools. These are fans. These are people who really believe in you, and they will give you the money. They're not going to interfere with what you do, okay? So 3F, family, friends, and fans. Remember, treat them well. How about funding a venture at pre-seed? How about angels? In the festive seasons, angels descend on us and give us money. How do you select the angels? What are their characteristics? How do they look like? Well, the types of investor roles or angel would like to look at is, where is the source of capital? Can they be your mentor and advisor? So they're talking about smart money, not just taking money from anywhere, right? Can they open doors, the network? Can they recruit? Because you need people to help you. Are they a good recruiter of talent? Sometimes you are the techies. You are the CTO type, and you need a CEO. You need a business guy. This guy may come in and then be your interim CEO, and then bring other people in. Are they good in PR and marketing? Technical expert. Can they be a board member? Means they actually assume some legal liabilities. So the angels are smart angels, all right? They don't just bring the money. They bring a lot more values to you. And one group of angels, there are many groups of angels in Singapore, and one group of angels are called the Angel Central, where they build a community, and there are 500 of them at least. And what they do is that they recruit people who are current and past entrepreneurs who can understand how to run or start a venture, corporate high flyers who can open up the network, family fund managers who have certain missions and maybe also to protect and invest in their funds and friends and families. But this group of people is what we say mentors, coaches, PR, networking, find you the pilot customers. So why they invest? Obviously, they must believe in you. Secondly, most of them have, made some good money. It's time to give back, right? Return to society, and also to keep themselves current, learning of new areas. And then, most of the times, people who are entrepreneurs, they want to get involved, but they do not want to be the CEO anymore, all right? And of course, do you have good returns? Because we are going in at very low valuation, high risk, but if you can manage the risk, you put in the smartness into the money, then maybe the returns could be 30 times, right? So they can invest direct, one-to-one into the company by having equity share, and normally people who put in over 50K, depends, sometimes 100K. They can syndicate, 3 angels come together, and then put in maybe if it's 200K, then one guy will say, I lead, I have 100 and get 2 friends of 50K and come in. This is a pretty good thing because you have more smartness, provided they are willing to spend the time to help you. And generally when you have the skin in the game, you have the money inside, you will help. Funding a venture by validation. What does it mean? What I'm talking about is crowdfunding. The interesting thing is over the last 10 years, there's a new way actually to fund a venture through the crowd. And I have been participated in a couple of these projects and is also running a couple of this campaign right and planning for the campaigns of certain products right now. It is a very interesting way to test the market, not just to raise funds, but really to test whether your product has what we call the product market fit. Your MVP, your minimum viable product, has the product market fit, that the customer really wants it. And this is very important because if you have a successful campaign, you will start attracting not just customers globally, but you will start attracting people who want to invest in you because you has a sellable product. But let me just bring you through what is crowdfunding. Well, one of the projects on crowdfunding is the smart helmet that I talk about, Lumus. And when we do the crowdfunding, for the very first campaign, we raised about 800,000 US dollars. And when we put on the show or the page itself, Opera really likes it. And Opera basically says, you can't put a price on safety, and this high-tech helmet has 22 LEDs and blah, blah, blah. Now, it also picked up by 2018 by Times Magazine that it is a life-saving helmet, right in the middle. 50 amazing innovations changing how we live. So have you seen it? Do a proper campaign. You can get recommendations from important people who can spread the words. You can get recognitions, which makes you a global product straight away. And this is very important, right? You can save a lot of marketing dollars. Now, the second campaign focused on a much more simpler product, 99 US dollars, and you see in the 40 days, it has garnered 3 million US dollars. That's a way for you to get the money and then do the production, right? Rather than do the production and hope that people will buy. So crowdfunding becomes a very important tool beside grants for you not to give out away your equity. And if you look at the kick track, which is basically looking at how the funding campaign is being run, well, we can see that it is run at 3 million US dollars, okay? And what happened is if you look at this graph, the lower level here is the goal, is the amount that you want to raise. However, you can see that on day one itself, it already exceeded the amount. Now, how do you do that? It's really great marketing campaign strategy. And once you can hit that, then what happened is that the media will churn the news. When media churn the news, more people knows about you. Marketing goes out, it's viral, and when it's viral, people pay attention to it, and they come and support you. Visit your website, the Kickstarter page, and then you can see that it grows, and finally it settled at 3 million US dollars, although what you want to raise is maybe about 150. So crowdfunding is a marketing campaign. It is a great way to establish a brand globally because you have backers all over the world. It is also a great way, if we are going through the retail distribution channels, to have not just global customers, but global distribution channels. People will call you to represent you. There's 2 points, 2 important points. First, right, global branding. Second, global distribution channel. And then what would be the last one? Well, people will come and say, I want to finance you, also global financing. All right, so do pay attention to this new tool of crowdfunding. Then, if you look at this, from Tiny Moss, it's one of my students, has a great idea as an enthusiast to shoot heavenly bodies. How can I take a picture of Saturn using a small little camera instead of the professional tools that I carry around? And he came out with something called the Tiny One, the world's smallest astronomy camera, developed during one of my class. He decided, and in class we said we should do crowdfunding, and he decided to go on Indiegogo platform, and he raised 672,000 Sing dollars for his very first product. Well, is this the end? Nope. He said, well, not just Tiny One, I'm going to go to Nano One. And Nano One is still again the world's smallest astronomy camera, just gets smaller. So he beat himself. And there he raised another 220,000 on Kickstarter. So two different kind of platform, but equally successful. All right? So you can see that crowdfunding is really a good way to test the product market. If your product fits in to that category. Now, I think let's try to look at another strategy. Simon, a Singapore company called Cool Mint or Not. And what do they do? Board games. All right, and I read board games. There's a board and a games. It's just a chess. How much money can you raise? Well, they started and they continue to use the platform to raise more and more money until they raise eventually about 40 over million US dollars. Now the question is, then the crowdfunding platform is now no more just for crowdfunding to fund your ventures. It has become a marketing platform, a new product launch platform, that every time you launch a product, you come here because your supporters are always there and they keep increasing. So a global launch of a new product. Well, so board games, you thought, wow, small thing, right? No, they have many, many such games which they develop and push out. And they become regular, it's a machinery, become operations. And the interesting thing is that they raise sufficient cash through this platform that they can get themselves listed on the Hong Kong Stock Exchange. So a company that comes up with products that really focus on crowdfunding as a mechanism can raise and sell enough products, churn enough revenues to be delisted on the Hong Kong Stock Exchange, IPO. Well, we come to the last category of funding a venture, the VCs. The venture capitalists, some people will say the voucher capitalists. Well, that is true or not? Well, they manage money, right? They need returns. And obviously, they will be harsh because they need to make sure financial returns. So, are they really a voucher? Well, it depends. You've got to understand what's the vision and the mission and how they work. Not necessarily a voucher. Some they're really, really friendly and they are on to help you achieve your vision and mission. So the important thing is to not just take money, right? When you take money from people or the VC, you need to know how does the VC work. So how does the VC capital, venture capital industry works, right? So you have the venture capitalists, the VCs. Where do they get the money? They don't pour all the money, right? They put some, and therefore they have private investors who put in the money, which they will then invest in you, the entrepreneurs, and based on your ideas. Depends on different stages. How they exit, IPO, or sell the company away, and therefore they sell IPO, they go to the investment banks or they sell the companies, get the money, and return the money. Obviously, the money that goes in one time, hopefully come back 10 times, all right? So this is how the VC works. How they structure themselves. So a VC, like for example, if I set up a venture capital firm, I will be known as the GPs, the general partners. I manage the fund. And for each fund, maybe I have a few funds. For each fund, I will create a venture capital fund, right? So I'm becomes the manager of the fund. And for each fund, who owns the fund? Obviously, the VC as the fund manager owns the fund, but somebody has to put in money, right? So we have what we call the investors, known as the LP, or the limited partners. So these are the people who could be individuals, could be corporation, could be hedge fund or mutual fund, whatever, family offices. They put the money and it's managed by the fund manager. So a VC could have a couple of funds. And usually the funds will have years of operation, 5 years, 7 years, 10 years. It depends on how long the funds and what do they invest and what are the mandates. And this fund therefore is invested into companies, all right? So they create a portfolio of companies. Generally, they prefer the portfolios in the certain area that the GP has expertise, has the networks, and is able to help. All right, so this is the way it's being structured. And that's very important to know that when you talk to certain VCs and the fund that comes in, are they at the early stage of the fund or the late stage of the fund or the early years? So if the fund lasts for, let's say, 7 years, if they're in a year one, therefore, they can wait for another at least 5 years. But if in the year 4 or year 3, then they know that in 2-3 years they're exit, and you're too early, you have no exit plan in 2 to 3 years, that will not be their target. So you got to be judicious, right? Don't waste time, because if you choose a fund that the lifetime is going to be very short, there will be pressure on you to deliver and to get exit. Well, some funds will roll on to another fund. So the investment in fund 1 can roll on to investment in fund 2, but there's no guarantee. So let's live with what we have right now, which is to look at the fund, see how long the fund is going to end, and therefore what are the exit strategies that the VCs expect. Now, if you look at the stage at which the investment is made and the risk of loss and the stage of developments, the VCs are looking at a 37%, which is quite high actually. However, at the seed stage, like the angels, they're looking at 72%, right? So the early stage has really, really high returns. It's with the risk, high returns. Well, does the government also participate? So Enterprise Singapore also will partner with VCs or prolific or well-known investor to co-invest. So what they do is that they co-invest with independent qualified third-party investor. So if you know of somebody who has been investing and they want to invest, you can apply to SG Equity for co-investment. And they also have selected venture capital firms. They select firms that will invest in the eligible startups through a fund of funds. What a fund of funds is, I'll match you, all right? I'll co-match. So therefore, it is quite a good path to go on, right? If you can tap on this scheme. And in this scheme, it depends about the kind of category of the technologies. Is it general tech or is it deep tech? And we are dealing with deep tech. So for deep tech, the seeds capital, which is the investment arm for Enterprise Singapore, can invest up to 8 million. That is the investment cap for each startup. What it means is that if they invest 8 million, the private guys probably also have to invest around that amount, so you get 15 to 16 million. But how is this ratio being worked on? It is for the first half of a million, is 7 to 3, which means this 7 is for $500,000 from seed capital, and the 3 is from the private investors. Beyond that, 500K to 4 million is a 1-to-1 ratio, and beyond 4 million is a reverse ratio of 3 to 7. Government invests less. So it's also a very important scheme to tap, especially for the VCs who are now have parties to share the risk together with them. So funding a venture, we have talked about a couple of options. We start with really bootstrapping your own money. Then we move to 3F, friends, families, and fans. And then we move to crowdfunding, where you go to crowd and you sell your products, right? And that is the best test of market share. It's very important because you get global customer, global brand, and possibly global distributors and retailers at the same time, while people are interested to invest in you. Then we go to angels, who can perform a variety of functions at your startup stage, introduce the customers, bring on board people, management, doing PR for you. And then we move on to the venture capitalists, which is much more serious play, but have a lot more requirements as far as exit is concerned, and there are grants which you can tap on. So where's the smartness here? The smartness must be in you, right? That you are smart enough to know what are the varieties of choices that you have in terms of funding formula, how much to get from them, and when, who to play what role. Money is money. How you make the money smart is really up to you. And that brings us to the conclusion of this episode on entrepreneurial financing the smart perspective. This brings us to the conclusion of the STEM Entrepreneurship, the Deep Tech Approach series. We have covered entrepreneurial opportunities, entrepreneurial business, entrepreneurial strategies, and entrepreneurial ventures. I hope that you find value in this series and we can continue to discuss in details. In the meantime, we'd like to wish you a happy closing of 2021 and looking forward to 2022 and a good future.